Welcome into the Real Estate Minute Show. Thanks for tuning in, to give me a couple minutes of your time, 2-3 minutes today. Something important that I like to bring up in advance, especially with new home buyers versus it coming up later as a big shock. And that is that if you are preparing to buy a house, you likely are going to be getting a loan to buy that house. Some people buy all cash, but that's a very small piece of this segment of buyers. So if you're like the rest of us, you're getting a loan to buy your house. Now, you got a decision to make when you do your taxes every year, right? I mean, if you work for a company, you don't work for yourself, then you're just getting a check, and that's what you show in your tax return, plus any investments you have or interest you earn. But if you work for yourself, the whole goal really of any taxpayer, I would say, for most taxpayers, except for the outliers, is to pay as little tax as possible, right? There are some of you that love to pay taxes, and God bless you. But those that try to make their income as small as possible within the law, with write-offs and all kinds of stuff, and the best that you can. If you're a solo employee and you work for yourself, you have more opportunity to try to do that, to offset your expenses of running your business, versus an employee where you're getting a paycheck and it's on your taxes, so that's a little bit more difficult. But if you do have the opportunity to kind of write off certain things that are within the rules, you want to pay as less tax as possible, which means you want to show your income as low as possible. But if you're going to buy a house, really low income is going to affect your ability to borrow. So there's kind of this it's built into the system to show your income as close as you can to what reality is and not write off as much as you can, because you're going to be a little shocked. So we had a client about 3 weeks ago who went in, told us, we didn't look at their tax returns. I don't ask for that. I asked for a pre-approval letter, so the lenders looked at it. But the lender looked at some of it, but not everything. And we're looking at houses that are in the $1.2 million to $1.4 million range. In that range, based upon their pre-approval letter, everything looked fine. They had the cash to put down 20% based on that number. We're great. We're out shopping. We get a house under contract. We go into contract. They get now deep into with their lender, who's doing an appraisal on the property. We're about 7-8 days in. And their lender finally got deeper into it. They work for themselves, and they made like a little league umpire salary after they were done writing everything off to pay as little tax as possible. They did very, very well. Their business does very well. They have a lot of income, but they have the ability legally to write a lot of stuff off to reduce their taxes, and they do. But a lot of lenders don't understand that, and they take the bottom line after all those write-offs, which shows a very small amount of income left over, which hurt their ability to buy the house. They could really, based upon that, they can only buy, I think it was like a $350,000 condo, but they make a lot more money than that. But they chose to take advantage of the tax laws and write-offs, but it affects their ability to borrow. Some banks can understand this. A lot of banks cannot, and they just take what your bottom line is, no questions. The banks that can understand that usually are relationship banks, smaller community banks, and a lot of times their interest rates might be a little bit higher just because of that knowledge. But be aware of that before you go and manipulate and work your taxes legally with your accountant, that it might affect your ability to borrow and buy a house later. All right? That might save you a lot of time. Hopefully this helped you with that. Take care. Have a great weekend, and we'll see you next week on the show. Thanks again for giving me a few minutes today. Take care.